The SPAC king has been stripped of his throne. Chamath Palihapitiya winding down two of his blank check firms after failing to find merger targets. There are currently over 670 outstanding SPACs in the market, and almost 560 are sitting, waiting, maybe wishing for a deal. So now that the SPAC bubble has popped, will this backdoor way to list go away, or will companies still try to SPAC their ways into the public markets? Let's ask Julian Klimochko, CEO of Accelerate Financial Technologies. He manages the Accelerate Arbitrage Fund, an ETF that tracks SPACs and mergers. Julian, good to see you. Sorry for butchering your last name. It's a tricky one. No excuses. In terms of SPACs, I mean, the heyday, I would assume most people think it's over. The heyday is gone. So maybe this is actually the best ending for investors to have their money returned at $10 a share, as opposed to finding a deal, jamming it through, and then losing money on the other end.
Yeah, you really nailed it. Like, we're in a tough market right now with the S&P 500 down 20% year to date, bonds down double digits, so investors really taking it on the chin. And SPACs get a lot of negative attention in the media, but if you look at that return profile that they can produce for investors, and just by way of that redemption privilege, it's really saved investors this year. Now, if we rewind 18 to 24 months back, we had this massive boom in issuance, seemingly half a dozen SPAC IPOs per day, raising billions and billions of dollars. And the fact is that we had way too much issuance, and now there's a bit of a hangover combined with tough markets, a tough economy, and many of these SPACs searching for deals, having trouble getting it over the finish line and ending up having to liquidate. But if you compare that to the de-SPAC performance, or those SPACs that complete their deals and then fall from $10 to $5 or lower, perhaps liquidating is the best result for investors.
So, Julian, you do say that there are some opportunities, as I would think that you would say, being a guy who tracks SPACs for a living in part and runs an ETF. But the examples that you give are companies that have been de-SPACed. And so these are completed transactions. And so I'm wondering, how much do you think of it is the ability? I mean, they found a deal already. So they found a deal when things were much better than they are today. So are there opportunities that you see today in this market environment for a transaction to be done and for investors to make money?
Yeah, certainly, as you saw, there are over 550 SPACs looking for a deal, and they have the cash to complete a deal. The problem is getting a private company or a target to dance the dance with them and go public in a very tough market. So if we can see that, and the types of deals that we're seeing work well in the current market environment are not those hyper growth, science experiment type early VC opportunities, but what's working in this market is consistent, classic businesses that are profitable, growing, and just more so mature than some of the earlier stage businesses or concepts that we saw going earlier. So if you're a SPAC that has the ability to complete a deal, you have deal flow, and can find a dance partner that is willing to go public in the current market environment at a good valuation for investors, then that can add a lot of value. And I think that's the formula in the current market environment to get a successful deal completed and not liquidate.
I was curious what you think is the best use of a SPAC, because it really feels like it's hard to understand why they really have a major purpose right now. I mean, I basically tried to get a SPAC going for my toddler just to see if I could get him into preschool, that differentiate him. But I'm really curious why this vehicle makes sense to you long term.
That'd be a pretty expensive preschool, but I digress. So you can think of a SPAC as, say, like a one-stock private equity fund or a one-stock venture capital fund. Where some entrepreneurs or an alternative asset management firm wants to put together a pool of capital and bring a new opportunity to the market. So it's just a different way of acquiring a company, bringing it public, as opposed to a direct listing or an IPO. The SPAC structure does have certain advantages over those alternatives for a company to go public. And there's different purposes for a SPAC. If we look at the supply and demand equation for the supply side. Obviously, can be lucrative if a sponsor does it correctly. However, if they don't, then they end up losing a lot of money if they can't get a deal done. And then on the demand side, look, the fact is, over the past 20 years, we saw a massive decline in public market listings. But what the SPAC did, that vehicle in and of itself, it actually reversed the decline. And we have seen a tremendous amount of new companies go public via the blank check. And ultimately, my thinking is that the more the better, whether you're a long investor or a short investor, the more supply, the more choice for investors, in my opinion. It's good all around.
Julian, great to speak with you. Thank you.
Thanks for having me on.
Julian Klimochko, I did it again.
Yep.
That's an interesting idea, Julie. I was thinking of NFTing my toddler's first artwork to pay for preschool, which is very expensive, by the way. Jeff Mills, I don't know if you want to take in the SPAC specific direction, or if this is just a sign of the times of the market that we are in at this point.
Yeah, and that was sort of my question. I haven't done the analysis, but I wonder what the de-SPAC or post-merger performance is over a longer-term basis versus just a traditional IPO, and whether they're kind of inherently more risky. But it's a risk-off thing right now. It's an investor preference thing. I just looked at the performance of kind of broad SPACs, down about 60% versus ARK, for example, down 55%. And those two things are very correlated, certainly much more to themselves than the broad market. So I think that's a big part of it. And we wrote a piece in mid-2021 basically saying, look, the SPAC isn't going anywhere, but the run rate, it was just ridiculous and unsustainable. And the biggest risk to investors was that these sponsors were going to go out, buy companies that were garbage, and then they were going to be stuck with those. So again, just to underscore the point, I think some of these liquidations, it's the responsible thing for the sponsor to be doing, and it's probably the best outcome for a lot of these investors.
So down 80% on the de-SPAC index is emblematic of high multiple tech. I just think there's a supply and a demand for capital out there, and there are good companies that need capital. I think there's too much hype on either side of this. This is an environment where good deals will come forward, and actually weeding out a bunch of these structures, not a bad idea.
And that's a great point. Over the summer, I think it was in August, a company, SeatGeek, that I use their product, and they had agreed to do a SPAC, $1.35 billion. They're going to come to market, and they called it off because of market conditions. Then they did a Series D at almost the same valuation, raising $230 million. So there are plenty of good companies that were going to use the vehicle to go public, but market conditions made it really tough. And the ability for them to raise in the private markets and actually have the capital, that's why they were going public, to get capital to do things. I think that's a good example. So things are kind of working, and the fact that these sponsors are taking the hit, giving the money back to investors makes sense too.
And I just want to quickly disclose, I sit on the board of a SPAC that's looking for a deal. So, I mean, it's an environment where there are good companies out there. There's a lot of deals, but there's a lot of these things that won't get done. So I just want to point that out.